Welcome back to the channel. I hope you're doing very well and you've got a coffee in hand because today we're going to be talking about Boohoo. Now, Boohoo, to clarify, is my largest holding in my portfolio, and they've done something that I think is, well, pretty stupid. So if you like this video, please drop one of these, as it does help out the channel a lot. So today I'm going to be discussing Boohoo's recent changes to their growth incentive plan and why I think it's actually a terrible idea, especially as a shareholder of Boohoo. Now, we've got this article here on the left that says Boohoo's share price collapses forces £175 million bonus plan rethink. And it says, under the new plan, a total of £175 million would be handed out over a period of time if Boohoo's market capitalisation reaches £5 billion. Now, since this, right, funny enough, Boohoo shares are soaring. Now, this article was released on the 15th. I think this came through about then. Let's say close of 15th was about, 46p. Well, it's up about 17%, so no small move in any way, shape or form. And it is to be noted that Boohoo's current market cap, which you can't see on the right hand side of the screen, is about £694 million. So you might go as a new investor of Boohoo and go, well, hang on a minute here. This is a huge increase. This is great for the investor. And let's read more of the article and explain why not. So, Boohoo has been forced to rethink its bonus plan after a unique and unprecedented set of macroeconomic and market headwinds experienced over the last 3 years. To me, that sounds a lot like excuses, but let's carry on. The Manchester headquartered group said there is little or no value in the existing growth share plan or the current management incentive plan after its market capitalisation, now listen to this, significantly decreased. As a result, it added they no longer operate as an effective incentive mechanism for this critical population who are responsible for driving business performance and delivering Boohoo's strategic objectives. Now, it should be noted that their previous growth incentive plan, around the idea here was, again, based on market capitalization. And you should note, right, that if the shares have fallen to that market capitalization is much lower now and they're rewarding an increase in that, that seems a bit weird to me. It's basically saying if Boohoo shares recover, then you'll get a reward. Nice work, executives. You're really doing well. And as we all know in the markets, the share price is speculative. It's volatile. So realistically, all it has to do is go up in a certain direction with no real reason behind it, and the management is incentivized for fuck all, really. Anyway, Boohoo's market capitalization stands at, well, we said about 700 million, but it did close at 46p on Tuesday the 15th. Now, that's a rise of more than 33% this year. Well, actually, it's more than that so far. Year to date now, we're on 48% of an increase so far, so quite a good push. And it says that under the new plan, a total of £175 million will be handed out if the capitalisation reaches £5 billion. This means the share price would stand at £3.95 for the management to receive the entire bonus, and that would be a 747% increase on the share price in this article, which was 47p. Now, the highest it's ever been is £4.12, and note that that was in June 2020. That's not that long ago, and it's fallen from there. Now, it goes into detail here who it goes to. Notably, it doesn't go to the founder, Mahmood Kamani, and instead it goes to the CEO, £50 million pay packet, quite a bit, the CFO, the co-founder, and also one of the sons of Mahmood Kamani, who is the CEO of Boohoo and Boohoo Man. Now, he's also said there's a few other bonuses here and that, the CEO will be well compensated. Now, the executive chairman and co-founder has said, I wholeheartedly endorse the Remunerations Committee's proposed growth plan, designed to rebuild a very substantial shareholder value within the next 5 years. Whilst these are extremely ambitious targets in a changed world, in my view, as an executive chairman and the company's largest shareholder, it is absolutely the right thing to do to align the interests of the management team and all of our hardworking colleagues with all of those shareholders. Now, sure, it can be an effective mechanism, right, to motivate your employees and directors. It's great when they're aligned with the shareholders, but the way that they've done it is not really that great. It's based on market cap, which I've said can really change, and it doesn't really matter really on the underlying performance of the business for the share price to increase erratically. Just look at GameStop and AMC, for example, where they were hyped and pushed up by Reddit groups, and obviously that would have ticked in a few boxes with Boohoo here if it's sustained above the 90-day moving average that they will obviously need before their bonus is redeemed. Now, there's minimal alignment, I really think, with shareholders. Now, you might go, well, Oz, hang on a second here, right? I'm invested in Boohoo. I've bought at £2 a share. Well, if they do get back up to £3.95 a share, well, hey, I've nearly doubled my money. Surely that's alignment with shareholders, right? Sure, it could be, and it's great for shareholders if you've invested at a lower average price, but not so great for the shareholders that maybe have an average at £3.50 and are now going, well, hang on, now my company is dishing out capital for people that have bought at a lower price. This isn't fair. And it doesn't necessarily say anything about growing the business. Now, you might infer that over time, the market capitalization is going to reflect the value of the business. So if the business is growing, market capitalization would also be growing. But this is long term. We're in the short to medium term. Things can go up and down as suggested. Now, it goes on further here to say that Ian McDonald, the chairman of the Remuneration Committee, added, the Boohoo Group has an outstanding executive team whose ongoing retention is crucial, particularly in an era where recruitment of such quality is more competitive than ever before. Now, from this view, I can understand here why, for instance, Mahmood Kamani, the founder, and also the executives here like this package. Now, yes, it's very true. It's going to keep people very much aligned with the company in terms of if there's going to be someone else like ASOS going, we want to poach your chief financial officer with a, like a bonus plan like that, I don't think they really want to leave any time soon. So it keeps the current experienced management within the company. Okay, that's a defensive move, and it might be in case of, the likes of Shein, the likes of ASOS, look to poach anyone, especially in a time like now where this could happen. And for Mahmood Kamani, he holds a sizable stake of the company, which is about 12 to 15%. Now, I don't know this off the top of my head, but a sizable stake. So it makes sense, obviously, if shares go back to £4 a share, well, he's back in the billionaire club. So for him, it's great, and that's why he's not getting any of the portion of this management share scheme, because quite frankly, he has a big enough sizable holding already. He stands to gain way more than any of them because his value increases, and at which point he might be able to sell a few shares, release a couple 100 million maybe if he wants to, and he's laughing, right? He's back, he's loaded, plenty of money to do all of the antics he wants to go to. And I want to say, really, that shareholder incentive plans can be very effective, and I think they are critical in making a good quality business. And therefore, I understand why this is, and it's really to overcome the principal agent problem. Now, this is where the management of the company are not aligned with the shareholders or the owners of the company. This is because the management are seeking higher sales growth, but higher sales growth doesn't necessarily equal profits. And when they're chasing higher sales growth, they might have incentives in their compensation that means when sales increase, they get paid more. So they might be trying to sell products, right? And they might be selling it at a really low price where they're not actually making a profit on it, but they hit their sales bonus, they get a bonus, but shareholders are going, well, hang on, revenue's increased, great, but actually our profits has decreased. That's not good. We're not getting any more value of the business. And if a shareholder was looking for dividends, for instance, this would mean that their dividend would potentially decrease as the earnings fall. Or if you're not a dividend investor, just remember that that earnings is going to be reinvested back into the business, and why that's critical for shareholder value over the longer term. Now, if I ran Boohoo, right, and here's a hypothetical question for you. If I was going to run the company, what would I do to incentivize the management, the executives, and the employees? What would I personally do? And I really like here profit sharing incentive plans. Now, Games Workshop has a very good one in place, and they've frequently given out quite a lot of capital to their employees, which has kept them happier than they would have been without it, that's for sure. Now, these are normally based on KPIs. Now, specific KPIs I probably couldn't dish out here, but Boohoo, for instance, is going to have a few that are critical for growth, that align with profits. I really like return on capital employed, which is your profits before tax, and that's over your assets minus liabilities. And this, a higher percent, is basically saying based on your money or your capital available, or your profits, this is effectively how much you're able to generate, how much returns you're able to generate on that capital that is used. And I think a higher percentage of this, especially versus, let's say, the company's stare, like let's say they set a high benchmark, if they achieve over that, then that should be good for the business overall. Perhaps another KPI would be to reduce levels of net debt. I know Boohoo's in a bit of a tricky position because they are currently unprofitable, but that way they could go, okay, keep leverage below this goal and you'll be in a good place. And let's say a profit sharing scheme where obviously if profit is able to grow by X, then they will get a portion. This way the management is aligned with the business, and I think it'd be a lot better. But as you know, Boohoo are very greedy when it comes to this, and obviously I'd have this weighted in terms of to the higher to the management, the executives, and a little bit to the employees as well, because they are important. But you've also got to be careful here that stock-based compensation isn't ridiculously high, because that's where you got the problems with the likes of your Google, your Microsoft and other American companies where their stock-based compensation is a real high proportion of their free cash flow. That said, will I sell Boohoo because they've got a quite frankly stupid growth incentive plan? No, but I should be keeping you in mind that whilst the shares are increasing, I'm not selling and I'm not buying more. You can see my portfolio here on free trade. I'm using the ISA account again because that's where it is, and the free trade web app because I'm still updating my spreadsheet. And you can see here this sharp drop today. This is rubbish. Boohoo share price, as you can see, stayed up, but the uncrossed trade at the end of the day, according to that, obviously dropped down. So my portfolio is actually worth what's on the thumbnail and not this. That said though, Boohoo's very much my biggest position, and I'm not going to be selling it anytime soon, unless the fundamentals significantly deteriorate, which I think is unlikely because I think the worst is now behind us. But as I'm going forward, even though the price now is 57% below my average price, I don't see it as wise to buy shares of this stock. I think they really need to have a significant turnaround, and maybe the shares will be 80 or 90p a share each then before I would consider buying more in. I think what my mistake was is I bought too much without consideration of valuation. I bought a company that lacks a proper moat, although they are very much a very dominant player in this industry. And going forward, I'm really going to establish risk management and diversification and balance things out. So let's say as Boohoo starts to make a good recovery, I may look to trim a small portion of that position, crystallize some losses, and move that into some other holdings in the essence of balance. Have a fantastic day, and don't forget to subscribe if you haven't already. Peace.